I'm Yahoo Finance Executive Editor Brian Sazio, taking a look at a live shot of the opening bells on Wall Street on this Thursday morning. An extra special, I would say, guest ringing the bell at the New York Stock Exchange. That is Disney CEO Bob Iger. Also, I see Mickey, I see Minnie, very important guests there, getting trading underway down there. They're at the Disneyland Resort in Anaheim, California, in celebration of Disneyland's 70th anniversary. NYC President Lynn Martin also there in attendance. You can see her on the screen. One has to wonder if this will be the last opening bell for Iger as Disney CEO. The company's decision on succession could come before year-end. Sources have told me. I'm actually rooting for a co-CEO between Mickey and Minnie. And over ringing at the bell, the NASDAQ is Lisa Hochstein, entrepreneur, Splitwell app founder, and cast member on Bravo's Real Housewives of Miami. Wow, interesting day. Not to spoil this opening bell fun, friends, but markets are still trying to get off the canvas after being put there by President Trump on Wednesday. Reports surfaced that Trump was ready to fire Fed Chair Jerome Powell. Trump walked those fears back, but markets remain on edge. Now, Opening Bid is all about serving up investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make decisions with all that money in your portfolio. Let's get a quick check on what's hot in the markets out of the gate. Yahoo Finance senior reporter Ali Canal joins us from the NASDAQ in Times Square. Ali, I mean, fascinating to see there. Mickey and Minnie and Josh D'Amaro, the head of the parks, also reportedly in running for Iger's gig.
Yeah, what a roster here, Sazi, for this opening bell. But we're seeing stocks continuing to chug along here. We did see positive retail sales data earlier this morning, along with jobless claims ticking lower. That's the number of folks that are filing for unemployment benefits. But right now we're seeing a bit of stagnation here. The S&P and Dow pretty much trading flat right now. The NASDAQ is up around 0.2%, and we did see some solid earnings. I want to quickly check the Treasury yield market because this is something we had our eye on yesterday, Brian. We're seeing the 10-year trade right around 4.4%. We know that if we hit 4.6%, that's something that could potentially start to weigh on equities. 30-year yield is still up over 5%. We did see that spike in yields after we heard those reports that President Trump wanted to go ahead and fire Jerome Powell. He eventually backed off those comments, but still important to keep an eye on the bond market. And then taking a look at some individual movers today, I have my eye on Lucid Group. Holy mackerel, this stock is on a tear. We are up over 25% at the opening bell here. And this comes after the company secured a $300 million investment from Uber to launch a new global robo-taxi program. This is something that Uber had been teasing for a bit now. If we take a look at Uber shares, they are pretty much flat at the moment. But as we know, this has been a stock that's been continuously growing. And I also want to take a look at some trending tickers on Yahoo Finance. A lot of these names have to do with earnings. You're seeing Taiwan Semiconductor up around 3%. Blockbuster earnings there. We're going to be talking about that a little bit more in the hour. And then also, if we take a look at PepsiCo, shares are up around 7%. This was a better than feared report, but heading into earnings season, Pepsi was down around 11%. So perhaps a low bar that they were able to cross here. Again, another name that we'll be talking about very shortly, Brian.
Indeed we will. Thanks so much, Ali. Appreciate it. All right, we're off and running with your daily guide to the biggest market drivers of the trading day. Here's what I'm watching. Number one, Fed attack aftershocks. Markets have stabilized a bit today after Trump-fueled tizzy on Wednesday. According to multiple reports, President Trump had sounded out lawmakers on whether he should fire Federal Reserve Chair Jerome Powell. Trump later walked back the reports in a press conference, but Trump's repeated attacks on Powell and the Fed have investors on edge after a record-setting run for stocks. Carlyle co-founder David Rubenstein told me he thinks Powell has done a very good job and Fed independence is very critical. We'll have more from my chat Rubenstein coming up. Number two, after a surprisingly lackluster first quarter, where it also issued a rare outlook warning, PepsiCo came back today with better things to tell investors. Maker of Pepsi Soda and Frito-Lay snacks served up a 9-cent earnings beat on the back of a $400 million quarterly sales beat. Importantly, the company maintained its 2025 sales and profits outlooks. PepsiCo CEO Ramon Laguardo tells me the U.S. consumer is still challenged, but the company just executed better in the second quarter. And number three, a bullish read on tech. Those looking for a bearish read on AI demand from chip giant Taiwan Semiconductor won't find it on its earnings release out today. The tech bellwether now sees full-year sales growing 30% year over year. Previously, it modeled for sales growth in the mid-20% area. The company also maintained a bullish tone around consumer demand for smartphones. Here to break all this down, Matt Bryson, Wedbush Securities Managing Director of Equity Research, and Yahoo Finance Senior Reporters Inez Ferre and Ali Canal. Matt, I want to go right to you. out of the block here, and I'm going to flip the script on this one. I want to start on tech, very much in focus here. Those TSMC results, which we profiled early in the week here, opening bid, setting the tone for tech. What is the read-through from TSM's report for tech more broadly, in your view?
Well, I mean, I think you said it. It tells us again that AI demand is really, really strong, and that there's just no change there.
Matt, off this results, do you back up the truck on NVIDIA?
I think with NVIDIA, they're the clear derivative here. They're driving AI. With TSM telling you things are looking good this year, I think things look good for NVIDIA.
Have you seen any signs of a slowdown in AI demand across your coverage?
No, I mean, on the AI side of things, it exactly the opposite. So over the last 3 months, I've been to California, been to Taiwan, and the supply chain has seen demand lift. There's still shortages of new Blackwell chips. So no, not seeing any slowdown on the AI side yet.
Inez, we've been covering, of course, NVIDIA's climb to over a $4 trillion market cap. It's still climbing, and they're really on a hot stretch ahead of earnings. But this TSMC report should put to bed, at least in the near term, concerns about AI demand.
For sure.
Yeah, no,
Go ahead, Inez.
Yeah, it's ironic that just in late January we were talking about DeepSeek and it was weighing on these stocks, on NVIDIA and others. Look, as your guest was just saying, this is really all about the demand for AI, insatiable demand for AI, and the fact that it is going to, the market may have been underappreciating how much demand you have when it comes to artificial intelligence and how this will change pretty much every industry across the board.
Ali, there's one number, I mean, a lot of numbers stood out to me in this TSMC report. But they're about to spend $40 billion on CapEx. And if there's any potential area of disappointment in large cap tech earnings, it's how much a Microsoft or Google are spending on CapEx. Curious on what you're seeing here in the markets off of that.
Yeah, and you're right, Brian. CapEx has been a big focus for investors, and I remember in some of these earlier reports when we did see aggressive spending from these hyperscalers, they were punished a little bit. But I think the fact that we're still in the early innings of AI, that's what multiple strategists have told us, and the demand is so strong, that's fine. They actually would rather see heavy investments in these areas because they know the demand is there. We have multiple catalysts. Earlier this week, we just saw that the White House approved those H20 chip shipments to China for NVIDIA. This is one of TSMC's biggest customers. And on the earnings call, the CEO said that, good for NVIDIA, good for us. So it just seems to be that's what's working within this market. And you can even look beyond the tech sector at some of these other sectors that are at record highs right now. Communication services, industrials, they all have touch points to that AI story. That's what's really powering this bull market. And that's what investors are excited about. So as long as we continue to see that demand, continue to see that spending in those areas, I think investors will be happy.
Now, one stock that has really continued to be left out of this bullish AI narrative, it's Intel. Now, they have on the edges start to restructure under new CEO Lip-Bu Tan. But is there a big move, in your view, he will make this year? Do you think he closes the door on this foundry business that they've invested billions of dollars in and they're not making any money from?
I don't think he can. I think they need the fabs to work, to get their model to work. And so this year, it's all about proving out their 18A technology, but you don't really see those products ship till next year. So I think Q3, Q4, it's about keeping the business alive and doing their best to make it look as good as they can. And hopefully 18A works out, and next year is a better year for them.
Do you think they will ever be a viable competitor to Taiwan Semiconductor in making chips?
I think maybe, but you're talking about their next process before they get into foundry. And so that's 2-3 years away.
I want to switch gears here. Start off the show really focused in on all things Federal Reserve. The markets continue to watch this drama between Trump and Fed Chair Jerome Powell. Inez, markets seem to have taken a breather, have taken a pause. They said, okay, maybe this is not going to happen right now, but they are still on edge.
Yeah, for sure. Look, I think that this is the red line for the markets. If President Trump were to fire Jerome Powell, then you would see, as one analyst said, a mess in the markets, and that would be on the equity side and also on the bond side as well. So, and hence, when you saw the bond yields ticking higher, that's when the president sort of pulled back on those comments. Another point that I want to make is also that the fact that you've got the big voices on Wall Street. Our David Hollerith wrote a piece about this. The big banking names that have been talking about Fed independence. This says a lot. Again, this is the line that the market is drawing. If the president goes to fire Jerome Powell, then you will see a market reaction. And the fact that you have heavy hitters on Wall Street that are talking about Fed independence just underscores that.
And Ali, some headlines crossing Kevin Warsh, who's reportedly also in the running for this Fed job, along with Kevin Hassett, on another network saying, quote, there's a credibility crisis at the Fed. Now, Warsh, his background is a little checkered as it pertains to interest rates. What do you think about all these folks just trying to curry favor with Trump? I think it's just sowing the seeds of credibility, of the Fed's independence credibility being challenged here.
Yeah, we have multiple names jockeying for that position, and all signs point to Donald Trump choosing a more dovish Fed. But you have to remember that there are multiple members that make up the FOMC. So even if we see a more dovish Fed chair, there still needs to be alignment among all of those other names when it comes to interest rates and the decisions there. And the Fed has its work cut out for them, right? We've seen really solid economic data, but we still have tariffs that are working their way through the system. Many strategists have told us that this full impact might not hit until the fall or possibly even 2026. So that's why we have a lot of divergence on the street about when we could potentially see those Fed rate cuts. Morgan Stanley doesn't think we're going to see any cuts this year. Other Wall Street firms like Capital Economics, they project a rate cut in December. And then if you take a look at the CME Fed futures, this is what markets are pricing. We're now at 50-50 odds for September. We were well above 70% just a few months ago. So that just goes to show how quickly the story is changing here. But clearly the president wants the Fed to cut interest rates. He's consistently reiterated that to the public. He's called Jerome Powell too late Powell, but he might just have to wait a little bit longer.
And lastly, Inez, I want to get over to you on this one. PepsiCo out better than expected sales and earnings this morning, didn't cut their outlook. When I talked to CEO Ramon LaGuardia, telling me consumers are still challenged, perhaps they do need that rate cut.
Yeah, perhaps they do, and they also probably need lower input costs. Look, PepsiCo is, right now the stock is higher because of a better than feared earnings, but they are leaning into the no sugar. They're leaning into the protein craze that's happening, the smaller packaging. They're doing those things right for certain, and this is what Wall Street has been wanting, the sort of the jolt that the stock needs right now. But if you take a look at year-to-date consumer staple stocks, they have been underperforming. Now, as far as going forward, there are headwinds to this industry as a whole. I mean, you've got the questioning about the ingredients, the high fructose. You've got the President Trump that's wanting real cane sugar to be used. That's a higher input cost there if these companies switch to real sugar. And then you've got, of course, the Make America Great Again, all part of this Make America Great Again initiative. So those are some of the headwinds going forward for the industry as a whole.
All right, we'll have to leave it there. Matt Bryson, good to see you. Thanks for hopping on here this morning, talking some tech. Appreciate it. Nez and Ali, you are sticking around. We'll be back with our Power Player interview for today. The Carlyle Group's David Rubenstein next on Opening Bid. Welcome back to Opening Bid. I'm locked in on a bearish call in Starbucks by Jefferies into the company's July 29th earnings report. Analyst Andy Barish slapping the stock with an underperform rating and a $76 price target. Says Barish, we think the stock has surpassed reasonable expectations for improving fundamentals. Barish is concerned about weak consumer spending data and the high costs coming for the company as CEO Brian Niccol invests in a turnaround plan. Before this downgrade, Starbucks shares had gained 23% in the past year. All right, for today's Power Player, I got a chance to speak with David Rubenstein, co-founder and co-chairman of global investment firm Carlyle, about the ongoing saga around President Trump's dissatisfaction with Fed Chair Jay Powell, Trump telling reporters in the Oval Office Wednesday that he doesn't plan to fire Powell after Bloomberg and CBS reports said the chairman was on the chopping block. Here's what David Rubenstein told me about the situation.
Well, President Trump, just as you said, walked back that statement. So what I just said before we went on the air, is that he said he's not planning to fire Powell. As you probably know, Jay Powell worked at Carlyle, and in effect for me, for 8 years. I hired him out of the George Herbert Walker Bush administration, a very smart man. And, you know, I recognize not everybody says he's done a perfect job, but I think he's done a very good job because he tells you what he's going to do or the Fed's likely to do before they do it, which is unusual for a lot of Fed chairs. And after it's done, within 30 minutes, he will explain in exhausting detail what they did and why they did it. And I think that's helpful. You may remember in the days of William McChesney Martin or Paul Volcker, they would do what they wanted to do, and you had to guess what they did and why they did it. Now it's much more transparent. I think Jay's done a good job in that. Secondly, we haven't had a recession since Jay Powell has been chairman of the Fed. Now, you know, recessions occur in the United States roughly every 7 years or so. And obviously the Fed chairman is not the only person responsible for there being or not being a recession. But I think we haven't had one because I think he managed the inflation reasonably well. Remember, inflation went to 8%. And it went to 8% because the Trump administration and the Biden administration both put a lot of money into the economy to keep us during the COVID period of time from going into recession. So we injected about $5 trillion into the economy without corresponding tax increases. The result was some inflation. Now, some people made a mistake initially of saying it was transitory, and I think Jay Powell would recognize that it wasn't transitory. But once they recognized it wasn't transitory, they began rate increases that I think dealt with the inflation problem. It's brought it down now, not quite where they want it to be, but lower than it had been. I think the most recent numbers showed about a 2.7% increase the last month, but the Fed's target is 2%, so they got a way to go.
David, how important is it that Jerome Powell finishes out this term in terms of importance to the Federal Reserve as an institution and as the major player in markets?
Well, remember, the Federal Reserve has two jobs. It was set up originally to take care of inflation and make sure the currency was strong. And then in the 1970s, it was given an additional job of worrying about unemployment. And the Fed is seen as being independent of the president in power because when you're independent, the theory is you can preserve the currency. You're not as subject to political pressure. And I think that's worked well for our country. And I think most people have commented on that, have said it's worked well. And the Federal Reserve is really the crown jewel of the federal governmental system in many ways because it's seen as very independent, very merit-oriented. And I think many of the people who are most respected in our country over the years have been chairs of the Federal Reserve, like Paul Volcker, and Ben Bernanke. But I recognize that there are some people who are not happy with the fact that the interest rates have not gone down as much as, let's say, they've gone down in Europe. But the United States is a more complicated economy in some ways than Europe, and Europe had lowered interest rates because their economy was softening so much, they had to help the economy move forward. We haven't had that kind of softening. So Jay Powell, to his credit, in my view, has not commented on anything that President Trump has said about him. In other words, if I was getting beat up every day or occasionally from time to time by the president, any president, I probably wouldn't be as quiet as Jay has been. But Jay has basically not responded, not taken the bait. And I think he'd like to finish out the term if he could, which finishes in May of 26.
And David, as someone that hired Jerome Powell, worked with him for 8 years at Carlyle, how do you think he's taking these criticisms? And are you surprised that he hasn't just, to hell with this, I'm stepping down and I'm going to go, enjoy myself for the next couple of years?
I haven't talked to him specifically about it, so I'm just surmising. But my guess is that nobody likes to be criticized by the President of the United States. Who likes to be criticized by the President of the United States? No one really does. But he hasn't responded to any of the criticism, which I give him great credit for doing. I don't think I could have done that because he's just decided to just take care of the job he has and worry about getting inflation down, and interest rates will come down when they are designed to come down. But remember, there is a FOMC of 12 people, 7 members from the Federal Reserve Board and 5 rotating members from the various Federal Reserve Boards around the country. 12 people, it's the FOMC. the Federal Open Market Committee. And they make the decision. Jay Powell is the chairman. Presumably he has a lot of influence, but it's not the only person making the decision.
How important is it that whoever succeeds Jerome Powell as Fed chair, that they could be someone that is independent from the executive branch, someone that could stand up to the president? You know, because I think some of the thinking, just based on people I've talked to, David, is that we get someone who has that direct line to President Trump, gets put in there because he promises the president they're going to cut rates, and now this person is doing everything the president asks them to do.
Well, I think the markets would respond better if somebody is seen as independent. The candidates that have been mentioned, some of them are excellent, and I think they would be somewhat independent, but obviously many of them have close relationship with the president. The president made it clear what he wants. Some of the people or candidates have already said they would lower interest rates, so maybe their existing view is that interest rates should come down and not because of presidential pressure. But I think overall it would be a good thing for the country to have a strong Fed chair and succeed Jay Powell rather than a weak Fed chair.
Out of all the names that we've heard, and you heard too, David, Kevin Warsh, Kevin Hassett, Secretary Bessent still in the mix, Christopher Waller at the Fed. Is there one person out of that group of four folks that are reportedly leading the nomination or top of mind with the president that you think would be best suited to do this job at this moment?
I know a number of them. I think I know three of them. And I would say they are, the three that I know are all talented, that all could do a good job. But until you get the job, you don't know, how strong somebody's going to be, and you don't know how independent they will be. So I just can't say now who'd be better, but I think of the candidates that I know, all of them would be able to do likely to be able to do a good job.
All right, let's keep this train rolling here. It's time now for our question of the day. Is a third term for President Trump possible, and what would it mean for markets? Still with me are Yahoo Finance's Ali Canal and Inez Ferre. I posed this very question to Carlisle's David Rubenstein. He broke down how a third Trump term could happen. Take a listen.
In my view, it could. Under the 22nd Amendment, which was passed ratified in 1951, it was designed by Republicans to keep people like FDR from ever doing what he did. FDR did 4 terms, and Republicans were not happy about that. So finally, in 1951, they ratified the amendment that they wanted, which says no one can be elected and serve as president more than 2 terms. However, there's a flaw in the way it's written. If you were elected vice president and the president resigns the next minute after he's sworn in or she's sworn in, and you succeed him, that is, I think, legal under the 22nd Amendment, not precluded. They could have drafted it much better. So it's possible.
All right, who wants this hot potato jump ball? Inez, I'm going to go to you. I think you look ready. Not that you're not, Ali. Inez wants to weigh in on this.
Look, I think if there were to be a third term, I think that the markets actually wouldn't care as much as if the Fed chair were to be pushed out early. That is because between Dems and Republicans, look, the markets just care about whether companies can increase their bottom line, and they have been able to under both Democrats or Republicans. So my take is that if there were to be a third one, you wouldn't see that much of a reaction. Just take a look at other countries. Venezuela's had a leader in there for a long time, and their markets nominally are at all-time highs. But I do think that, again, with the Fed chair, that's a different story.
Well said, Inez. Ali, this hot potato over to you. This, if it were to happen, and David writes more about this in his newsletter, no idea how he even finds time to do some of these things, but it would be a real expansion of the power of the executive branch, to say the very least.
Yeah, and I would be very curious to see how markets would react here, particularly the bond market, which we know has been a big checkpoint in general, especially for this administration. You can even look back at the April tariff announcements. We saw a huge surge in the 10-year. President Trump admitted he was watching it and backed off. Now, look, for something like this, Trump has floated the idea. Then he said he wouldn't be considering it. We have a top DOJ official not completely ruling it out. And look, with this administration, you have to take him at his word, but I think to a certain extent, I don't foresee this happening. But Inez brings up a good point that I do think the removal of a Fed chair, the firing of a Fed chair, interfering with Fed independence, that is the biggest risk to the market right now. And we saw that in just a sheer reaction in stocks, bonds, and the US dollar yesterday.
Also, well said. And I should mention, too, he would still have to run again. All right, Inez, Brooke, good to see you both.